Hi, this is Jeffrey Cohen, and this is week 6. So thank you very much for listening. We do a Chicago Quantum market wrap-up, and we talk about both the markets and we talk about Chicago Quantum and our progress. So here we go. By the way, at the end of the meeting here, I will add the key takeaways, which could be edited during the call, right into the video description. So the first is we did our 2021 board meeting, and our focus is clear. We are focused on using our proprietary quantum algorithm and our platform, which is both classical and quantum, in the financial markets. Our 2020 revenue increased, our loss decreased. We are a small firm, we're very frugal, and we have large aspirations. So for those who have supported us, for those who have purchased our services, I want to thank you. The second is we did a run on February 7 on Sunday, and we analyzed out of 3,500 and change stocks, we picked the ones that paid a dividend. It's not to say they will pay a dividend in the future, but they paid a dividend now. And so these came out of the 2 NASDAQ exchanges, the larger ones, the Global Select and Global came out of the New York Stock Exchange and came out of the New York Stock Exchange American. And medium risk level, we can do high, medium, and low risk now. Now we can do dividend and non-dividend, and it picked 3 stocks. It picked DIN, which is the company that owns Applebee's and IHOP, both amazing restaurants. I love IHOP. Since the pandemic, I haven't been able to go, and our local stores have closed. Cosmos Energy, which I cannot go see because they're an overseas oil company. Cosmos Energy is a stock that we have picked in the past, and we have actually bought and sold in the past. And SMLP, which, by the way, what a surprise, Summit Midstream Partners is the one stock that we are long in. And so it picked it this week on Sunday. So you can just imagine the good feeling that we got. And these 3 stocks are intended to be held in an equally weighted portfolio. I'm going to show you a picture of what it looks like. So we ran it, and then we took a look this week. And so here's what the stock looks like. I'll leave it, bring it over here. So you see Cosmos is up, down, kind of flat, down, up, flat. Kind of looks like it's forming a cup with a handle right here, which is usually a good sign, although I am not a chartist. If you look at SMLP, this one fairly flat. You've had a little fluctuation, like up 4% when this was up, but it has a different trajectory, a different movement. And then it actually came down while Cosmos Energy was actually making an upswing. And then pretty flat for the rest of the week. A slight uptick at the end. And so these are not the same shapes. That's in purple. The third in blue is DIN. And restaurant company, came down beginning of the week while the oil stocks were going up. Good solid recovery, was positive midweek, and then came back down. So if we take a look at these stocks, in fact, this is a little, when I moved it, I shifted it a little bit, but we could take a look. We picked this stock as of the 7th. So on the 8th, so what you do is you would start the week on the 8th, and you see, all right, so up 7.5% for one of the stocks, up 2% for the other, down 3.4 for the third. You add them up, you take the average, you come up to plus 2, and then you compare that to the S&P 500, which was up 1.4. So you would have made 2 full percentage points this week, 50 weeks a year, that's a nice return, versus a market that has felt very negative, but actually was up 1.4% for the week. So just wanted to show you what that looks like, what our picks look like. They zig and zag, and Jeff, what does that even mean, right? So we are evaluating now based on some discussions we've been having on if and how we can structure options prices, an option pricing analysis, and an option selection analysis on a quantum computer. A couple things. One is it's not going to be simple. It's going to take a lot of math. It's going to be computationally intensive because think about it. If you have one stock that maybe has 10 time periods, 10 different puts and calls, and you can be long or short, suddenly even one stock has a lot of choices. Now imagine running through this for 3,500 stocks. So tricky. Maybe the quantum computer gives us an edge. Maybe it doesn't. But I guess maybe I'll make the point here, right? This is a very large scale computational problem. And so truthfully, I'd like to see whether this could work or not. So the third, I know earlier in the week I talked about Microsoft Azure Quantum, and one of our associates, Alex Kahn, and you've seen a picture of him from earlier posts, he ran a random matrix in the form of our quadratic binary optimization, unconstrained binary optimization problem on Microsoft Azure Quantum. So he takes a matrix, he forms it the way we would do our stock problem, he fills it with random garbage, and then we run it. And he was able to apply our quantum algorithm, the Chicago Quantum Net Score, on the Microsoft Azure Quantum Inspired Optimizer. That's what it's actually called. MAQIO. MAQIO. It's equivalent to a digital annealing solver, like one that you might see from 1QBit or Fujitsu, I guess even Atos, or any of the simulators, like our D-Wave simulated annealer. It's classical, but that's okay. It found the right answer versus running it on a simulated annealer, so we know that it worked properly. And he also tried the same problem on the D-Wave quantum annealer, and we received 20 of, let's say, the 500 or 1,000 hits of that optimal answer. So hats off. Microsoft Quantum Azure Inspired, or Microsoft Azure Quantum Inspired Optimizer for working. And by the way, for those who like that matrix stuff, you need to give it a full matrix. You can't just give it the top half like you do the D-Wave quantum annealer. We learned that over some pain, so that's okay. So full matrix when you're using the Microsoft Azure. The next is Alex Kahn, again associate in Terrell France, who's also kind of affiliated as a researcher with the team, made a presentation to the Cayman Islands, Cayman Tech City, Digital Cayman, and Kirk, which discussed the general quantum ecosystem and the progress. And they also presented our research and results, and then afterwards sent out a nice message that said, please buy a run. It's really cool. You're going to love it. And it was nice that they did this. I'm going to show you the... here's what the YouTube looks like. I'm going to have the link right here so you can watch it on your own. And there it is. 73 subscribers. It's already got 3 thumbs ups. I guess I should also give it a thumb up, but I haven't yet. Thank you on behalf of Chicago Quantum. Just to show you that we're nice. Say thank you. So it's pretty cool. Pretty cool. We have another video out there, and what I'm going to do is I'm going to save that video into quantum videos and understanding the quantum ecosystem. So again, thank you very much, Alex, and Terrell. Terrell France is affiliated with the Harrisburg University, by the way. Now we get to the interesting part of the broadcast where I talk about SMLP. This actually got a mention on Yahoo Finance in the conversations of SMLP, and I just want to be fully transparent, right? Because we're looking at stocks, we're taking people's money, and we're analyzing stocks. So I have to be very transparent with where we are. So I, Jeffrey Cohen, am even longer Summit Midstream LP this week. I actually added shares in the week, which is funny because our average cost was in the 15s, and here I am buying stocks in the 19s and 20s. And so it's a real commitment. And in fact, we have buy orders in on call options for March. We're also very interested in the price of the call options in June to come down. If you guys are listening, the guys on the Ask, there's no way you're going to charge $3 for a call option when I got to pay $300 for 7 shares of stock. It's just insane. These are adjusted options, by the way. So we are very long SMLP. We are optimistic about the long-term fundamentals of the company. So we discovered it. Actually, I looked all the way back in November. We discovered SMLP through our quantum algorithm. And as I told you, we just we ran it and it came up Sunday, which is great. But now we've been doing a lot of fundamental research, a lot of due diligence. And I got to tell you, if you're going to invest in a limited partnership, common units, you really have to understand the business. So we do. We understand it a lot better. Number one, you look at Yahoo, and all of a sudden, let me show you. Let me show you if I can find it. You go to Yahoo, and you say, all right, how many shares you got? And so you look at financials. I mean, this is actually important because it's materially wrong. Okay? It's wrong. So don't do it. So we look at the last quarterly from September 30, and I'm assuming the shares issued are fixed for the reverse split. I mean, I can zoom in here. You see it's 3,775,000 shares. So you start, and that's that number down there. So you start to see, oh, 3,375,000, multiply that by like 20. So let's say the whole thing, 4 million shares, 20 bucks, $80 million valuation. Take a look, 76, close enough. So they're valuing the company at 80 million. And so you might look at that. You might go back to the financials. By the way, it's very important to just be comfortable with the actual financials that they publish with the SEC. This is just the kind of the quick and dirty. But let's take a look at their balance sheet quarterly. By the way, when you look at assets, try not to look at intangibles. Only look at tangible assets like cash, like investment, like oil and gas in the ground, like pipeline investments. And so if we just take a look at everything here, net tangible assets minus 200 million, that's not helpful. Let's look at tangible book value, 600 million. So you would compare those two numbers. You would say, oh, 60 million valuation, market cap, 600 million book value. This thing's a screaming steal, and I got to buy it right now. But you'd be mistaken because we actually did some homework, and we found out that even assuming that the warrants aren't exercised, there's warrants were given to the ex-general partner at $15.345. They can be exercised anytime between now, I believe, and May of 2023. So you have another 666,667 shares exercisable. So whether you want to look at 6.1 million or let's just call it 7 million, that's fine. Let's go with 7 million real conservative. That's a $140 million valuation. Now it's still a screaming deal against 600 million tangible book value, but it's not quite as good. And so there was someone in Yahoo Finance in the conversation boards who started talking about those ratios, and it was obvious to me that they hadn't understood. They hadn't gone through the work of evaluating. So when you think of SMLP, you should think of 6.1 million immediately tradable shares and another 700 million that may or may not be tradable because they may or may not have been exercised. We've also been studying the EE pipeline. For those who follow us on Twitter, it's Chicago_Quantum. You'll notice that we talked about a pig launcher and a pig receiver. And just your first visual has got to be pretty funny. A pig launcher, I'm thinking like a catapult from the Middle Ages. But no, a pig launcher is where you put in the pig, which does repairs, maintenance, and other duties inside the pipeline while you've got product going through the pipeline. It's a cost effectiveness measure, which I think is great that they got the pig for the pipeline and they've got it for 3 of the different segments of the pipeline. Each have a pig launcher and receiver, and so it's nice to know about that. We're also very eagerly awaiting the before the opening of the market, February 2026 earnings call. And so the other thing we did some homework, which is not so simple. We can see 2.2 million shares of institutional holdings as of the 12/31/2020 reporting date. And that's among 25 investors. Now, let's be honest. One of those investors has 9 shares. I don't know. Maybe they just started or something. But 25 major investors with 2.2 million shares. So the way I look at it is it's building. It's building its institutional following, given the raising of the credit rating, what I hope to be, knock on wood, a very good earnings report, and a cleaning up of the balance sheet, a simplification of the capital structure and the ownership structure. And so I wouldn't be surprised, my opinion only, that if I look at this thing in 3 months, maybe I see 35 institutional investors, maybe 40. And by the way, once they start paying out a dividend, and they've got restrictions on their last, the last amendment that they made to their borrowing, to their lines of credit, to their credit line. There are restrictions as to when they can pay a dividend again to unit holders, but that's okay. Once they start paying that dividend, you're going to see a lot more institutional holdings. So I close you with a thought. This is a risky position, so please do your due diligence before investing. Thank you. So let's keep going. I'm going to shut that one down there. I was actually going to show you some chart pattern on SMLP, but honestly, no thanks. It's not that interesting. So we changed something in our model that's pretty important. The risk-free rate in our model has always been 1%. And the reason is, so by the way, that is a floor that we set. So we set a floor of 1% because I was getting 1% in my Goldman Sachs account. I have a money market account. You know what? I can't find 1% anywhere. Legally, that's FDIC insured. I see about a half a point. So I'm going to, I maybe, if I squint, I see 0.6 being offered, special rates, right? So if you're an individual investor, probably the best you're going to do is 0.6%. And so we've lowered our risk-free rate, the floor to 0.6% from 1%. I also just want to mention that long-term rates for the U.S., those risk-free rates, are rising. And so yields, we hit 1.2% on the 10-year Treasury. Lots of reasons why. Probably because we seem to, for the pandemic, we seem to want to keep printing money. And it's one thing to buy debt with the money. At least you have an asset equal to the cash that you put liquidity into the system. But now in this case, you're giving money to people and you're trusting that they spend it wisely. And so it's going to be tough to get that money back, right? The next, and maybe I can show something nice while I do this. So Federal Reserve Bank. So in fact, I do have a Federal Reserve Bank chart here. Let me dig it up. There's my Federal. There it is. I love the Federal Reserve, by the way. Thank you guys for doing everything that you do. You work so hard to protect our economy. And I appreciate you. I don't know that everyone else talks about the Fed in such glowing terms, but I truly do. I love the Fed. So these are total assets of the Fed. So think of it this way. When the Fed buys debt, they don't like put a match to it. They hold it on the balance sheet. So the Federal Reserve is earning interest, right? So they want to buy IBM commercial paper. They want to buy mortgage-backed securities. They want to buy state and local government debt. They want to buy just federal debt, like debt from the Treasury. They can do that. They put it on the balance sheet. They earn the interest. By the way, they're the ones making the 1.2%. I think that's terrific, right? Because the Fed makes a profit. I like that. But here's the thing. The Fed has now, since July, when we stopped tracking, of course, has been growing their balance sheet. I don't like it. It's up to $7.442 trillion. And that number is going to go up probably by another 120 million a month, 120 billion a month that they've promised to keep injecting liquidity through purchases. That doesn't include other ways that they have of injecting liquidity in the system. This is unparalleled. I thought 4 trillion was a lot, which got us through some of the economic problems, from a few years ago, and now, 4 turns to 7.4. Just want to point that out to you. The Federal Reserve is doing everything it can to keep this stock market rally booming and to keep jobs being created and keep money in the pockets of the average American and money in the pockets of businesses. It's a very different response, let's say, than from the Great Depression, or even in 2008, before they got busy, where money just disappeared. And when money is hard to get, interest rates rise, but more importantly, it's just hard to get. And so you end up really struggling. So I just want to talk a little bit about this. So I listened to the Federal Reserve Bank head and others talk at the Economic Club this week. And so here's what they said. These are my words, my interpretation. They said they would continue their accommodative stance, buying $120 billion in debt securities each month. This does inject liquidity in the system, but again, it puts it on the balance sheet. The second is the Federal Reserve Bank has embraced the concept of an average inflation rate. So inflation can be more than 2%. They're not just aiming to hit 2%, but it's all right. Go 2.5. Go 3. As long as on average it's going to be 2. It's a very accommodative monetary policy statement, because the definition of inflation, at least when I was at University of Chicago in the economics department, was money supply minus economic growth. So true money supply has to go up at least 2%, if not more, than economic growth. So economic growth is probably close to 0. This shouldn't be that hard. But when the economy is really struggling through COVID, we must be destroying money. We must be destroying money. And that must be what's happening, right? And you would think with the stock market going up, you're creating money, but maybe not. The third is they continue their focus to restore maximum employment by whatever means are necessary. And my key takeaway is we, the Federal Reserve Bank, FRB, will continue to inject liquidity into the U.S. markets and build their balance sheet. Later, when the economy is strong and it can handle it, we'll raise monetary taxes. We'll drain liquidity from the system later. We're not worried about it. We can't afford to worry about it. We can only afford to worry about it when we've achieved our maximum employment, 2% inflation, and the economy's booming. So I recommend you listen. You may have political feelings about this. That's not what this broadcast is about. Just take a listen, and then would love to hear from you. By the way, my lines are open. In fact, no one is giving me an Ask Me Anything. So I'm going to say AMA, for those who know what that means. All right. So what's funny is the markets, I thought when I looked at the S&P 500, the market was going to be down. It's actually up 1.3% this week, which isn't bad. But the markets were down. It's like they were emotionally down. There was a lot of worrying going on social media, a lot of negativity. I thought there was going to be gloom and doom. And so the other thing I did notice, though, is first off, happy Chinese Lunar New Year. And that could be where some of the activity, some of the liquidity, some of the momentum drains out of the system because the Chinese are celebrating Lunar New Year. So that's great. First off, happy Chinese Lunar New Year for everyone out there who celebrates. And just don't be surprised if you see a little less activity next week. This is a worrying thing that we saw, so I'm going to talk about it. Over the counter. First off, Jeff, what is it, right? What is over the counter? What is it? So let me tell you what it is. By the way, I have market questions and free data. Yay, free market data. And so I just added a whole thing about over the counter. Because I think it's important that people there's a lot in here. I'm so sorry. I just feel like I need to teach, right? Part of this whole thing is to teach, not just to make money, right? So, what is the over-the-counter market? This is where stocks are not listed on a formal exchange. It's where they're traded. They're unlisted stocks. It's a little bit like a sales counter at the butcher shop. Yeah, I'd like to buy some stock, please. Okay, there's no brokers. There's no regulation, very little regulation. FINRA regulates it, but not much. So it's a dealer network. So I'm looking to buy some meat. I'd love a T-bone steak, maybe 20 pounds. Jeff, I'm not sure how much to charge you. I haven't sold T-bone all day. Let me make up a price for you. Let's see what you like. See if you can handle this price. So the bid ask is set more or less by these dealers, and there's not a lot of liquidity. It's not like you're going and there's 500 people looking to sell you meat. You're going to a meat counter. Another way I think of it is it's like a big Discord channel or a squawk box or a phone tree where you're asking people to buy or sell stock. Look, I'd like to buy 10 million shares of Amalgamated Widgets. Half a cent? Sure, it's great. You don't realize that it sold for 1/4 cent an hour ago. So there's no price reporting transparency. Trades happen between two parties without strict reporting requirements. And so what makes me concerned is there's a potential lack of liquidity in the shares that you buy and that you sell. And so executing a trade at a good price or executing a trade at all if you need that money might be difficult. There's counterparty risk in the over-the-counter market. Who's on the other side of the trade? What if they go belly up? What if they can't execute? What if they can't get the money? Will there be anyone there when you need them? At least with an exchange, there's compliance and there is that liquidity. And then the third is the equity securities. They're called unlisted for a reason. They may have failed to meet even the minimum requirements to list on any of the stock exchanges that we take for granted. You may be buying a stock that doesn't have enough revenue or doesn't have the capitalization, hasn't been in business long enough, doesn't have the compliance requirements. So Investopedia does have a page that discusses the pros and cons that we recommend people take a look at. And so I want to go back here. This is very important to me. So some very, very popular people that we follow on Twitter, that they are not providing investment advice. They are not recommending when to buy or sell. They're not responsible. But you know what? Like any celebrity, people listen to them. And so they're guiding individuals into specific stocks that are on the OTC. They're actually saying, we're moving to the OTC, right? There's no more good priced under $1 stocks listed. So let's go for some unlisted stocks. Let's go to the OTC. Let's make some money, man. What I worry about is this is troublesome. Hang on one second. It's troublesome to me, and we are sounding the alarm on this trend. We just saw it this week. For any of those individual investors who might watch this broadcast, it's dangerous to follow them to the OTC. In my opinion, unless you have guts, real guts, and real experience, it's like playing poker with strangers. You walk up to a table, you don't know. Is it fixed? Are they all friends? Are you the one that's going to get taken advantage of? I don't know. So, risks are significant. So, last but not least, back to some good news. D-Wave lists us on their website. Actually, the guys pointed this out to me. We have a weekly call. And they host a video of me speaking to their user groups in 2020. We went to their user conference, and they asked us to talk about our application. And this is nice. You go into D-Wave, you look at the finance applications, and right there at page 2, or you can just type in Chicago Quantum. And there it is. U.S. Advanced Computing Infrastructure. Chicago Quantum has built an equity portfolio optimization app that helps investors and investment managers select groups of stocks and buy and hold. At this time, this was our second paper, we had proven that we could run 60 stocks at a time. Now, we run 3,500, and we can run as many as 130-ish on the D-Wave. So we're doing a little better. D-Wave's doing a little better. It's nice. But so we're part of the D-Wave ecosystem. I just wanted to point that out to you. Maybe that helps people to feel confident. And then I'm just going to do a quick scan, just because markets felt negative, but I'm not sure that they were. So we take a look at, by the way, I love Finviz. We talk about this every week. Here's the weekly performance. And you see, like, tech is up. Not everyone's up. So Amazon and Tesla are down, and Apple, but lots of financial services is up. Energy's up. Restaurants are mixed, right? Yes, pretty mixed. Railroads are up. Industrials are up. So the key to this is industry by industry, we've started to diverge. Certain industries doing well, certain industries not doing well. That's different in this market. The second thing, if you look at the world market, you see that, and again, this is for the week, a little mixed. The good news is that every market has green, but not every market is all green. So it looks like this week was a stock pickers week, an industry week. We'll look at the S&P 500. We'll look at it for the week. You know, a lot of chop. Look at that. If you were around, I remember I was online February 10th at 10:30 a.m. People freaked out. There was like a flash crash. But I mean, it wasn't really a crash. It was 50 points, but a percent basically. But still made people nervous, right? But, you know, up very strong into the finish. NASDAQ. Boom. Had a bad couple of minutes. Up strong at the end, up for the week. Got the Russell 2000. Same thing. By the way, less of an oomph. So an oops. Right? It wasn't a full percent. By the way, they had another oops on Thursday, which did affect us because small stocks tend to have higher betas. And, you know, up marginally up for the week. We like to look at crude oil, right? Crude oil. Wow. Pretty flat for the week. Actually came down and tested on Friday where it was on Monday. And then, boom, ended the week very, very strong. We look at gold. When the dollar, when the dollar's weak, gold's strong. But look at this. Gold's a little higher, but is not showing much sign of strength for the week. Let's look at the 10-year Treasury. And this one, I'm going to go a full year. Treasury rates were much higher, kind of steady state. Pandemic comes, we just drove them into the ground, 0.6. Kept them there, 0.54. And then a slow, steady rise up as the economy more normalizes. For the week, you can see, right, long rates really jumping on Thursday into Friday. It always makes me nervous. I'm a yield curve guy. So let's look at the dollar-euro. So the euro is $1.2130. I think last week when we spoke, we were in the $1.20 range, and so I remember saying, I remember $1.21 a euro, and we're back, right? So Bitcoin. Bitcoin's interesting. Bitcoin had a rough middle of the week, came back strong. It's interesting. Look at it for the year. Of course, it's crazy when you look at that, right? You could have bought a Bitcoin for $5,400, and now it's almost $50,000. So, but for the week, pretty flat Thursday and Friday. And then finally, natural gas. So natural gas has a whole story to it. You see natural gas more, the futures, March futures. I mean, they were up Thursday. I was pretty excited, right? It hit $3. I actually called, by the way, $3 futures in 2021. And it happened within about an hour of my call. So I want to take credit. By the way, it was 297.7 when I called it. So it was just a little dip. But dropped all the way down, right? So the idea is that we're going to see more production. We're going to see more capability in producing gas, and maybe the pipelines will start to clear a little bit. But in certain markets, we have an issue. So there's not enough pipeline capacity today to get natural gas from where it's produced and where it's plentiful to the markets where it's used. And so one of the reasons that we also discovered SMLP was because of the Double E pipeline. The Double E pipeline connects a couple of areas where they have clients, including ExxonMobil, and moves it to the Wawa hub. So the Wawa hub it allows it to interconnect to the Kinder Morgan, what do they call it, the gas superhighway. And so that'll bring the gas east through Texas and potentially even all the way up to New York. And so now you're taking natural gas from where it's being produced and you're sending it to those who need it most. And it's really cold. I don't know if you know, but we have like 2 feet of snow in our backyard. And we're in Chicago, right? People need natural gas. And so we have an obligation to have enough pipelines to get the gas where it's going. And so I want to thank SMLP for their hard work. And they've been starting construction, at least the planning for construction for Double E. That's about it. So we've been talking for a little while. I'm going to give you my 1 minute. Oh, before I do that, no commercial yet. So we go on Medium. This is chicagoquantum.medium.com, and we publish our stock picks if we didn't have a client to pick them. Now, I don't publish them the minute that I make them because you're supposed to pay me for that. But a couple days later, it doesn't hurt. So we published this week the pick we made on Sunday night. Dividends paid, medium risk. Let's take a look. So first off, because we do research and we're still up for an NSF grant, we're still hoping, by the way. The NSF, if you're listening, give me a call. Sure could use the money if we're going to be doing all this like real quantum stuff. So we run 3,514 stocks. We data validate them down, both dividends and data availability, down to 1,631 stocks. These are stocks that paid a dividend in the past 12 months. Our first goal is to find an efficient portfolio that's large, 128 stocks. That's great, because if you're an investment house, you're not going to buy one stock, right? You're going to buy 128. We see companies with 1,000 stocks, right? This is great. So equal valuation, 128 stocks. You can start to get a feel for where you need to be. And then the second run is we search that portfolio of 128 stocks to find the best portfolio. Medium setting. In fact, in this case, we found 127 stocks, not 128. The best that we found was DIN, KOS, and SMLP. The second best portfolio we found included WY. Third best portfolio we found, and these were all kind of in the ballpark in terms of our risk score, our Chicago Quantum Net score. ENBL, KL, QEP were added. So model likes oil and gas, let's be honest. I don't know why. Maybe because the betas are so high. And depending on your level of risk, you might say, because if you had bought this analysis, you would have gotten these portfolios and others. And you might have said, you know what, Jeff, I got it. Those three stocks, that's where I want to be, but you know, I'm not that comfortable with that level of risk. I'm buying 6 stocks, and you know what? Maybe I'll toss WY in there as well. So I'm going to get a lot of diversification. I'm going to pick 7 stocks, and I'm going to town. It's not a bad outcome. By the way, it's really hard to invest in a market when social media feels negative, but the spider is going up, and interest rates are going up, and you're not sure where to turn, and maybe your fan, like the people you follow on Twitter are telling you to go over the counter. In this case, even though it's a week late, it's probably not a bad run for you. take a look at these stocks. And what will happen is, so we also are starting to publish some other data. We found that this is real cone-headed kind of stuff. You got to kind of love that math right here. So in the 127 stock, what we call an all-star portfolio. The reason we call it all-stars is if you get to the 127 stock portfolio, you're a good stock. We then picked the best stock out of the 127. Now, just recently we retested the all-star concept. And we just ran 3,000 whatever to the best 5. And then we ran it, 3,000 to 128 to 5. And it pretty much came up with the same answer. So the concept of an all-star team works. But which of those individual stocks has positive skewness? Which means it's the mean, median, and mode are not the same. It's got a skew or a positive tail. So it will tend to have a couple of very large returns. These are daily returns. So you might see if the typical return of this stock is 0.1%, and with the standard deviations, 2 standard deviations, maybe you see 2% or 0.2%, 0.3%. It might have been a 5% gain or 3% gain, right? Oh my God, it's crazy. So a 0 is a normal distribution. So this is greater than a 1.25 skewness. The other is leptokurtic. Now this one, 3.0 is normal. You don't need a lot of kurtosis to be leptokurtic. We're looking at a 3.25. Very few stocks have kurtosis over a full year. And so that means that the stock has fat tails. The stock has tail risk. The stock has, if 96, 98% of the time the stock moves within 1%, the stock has a chance of popping 5, right? Popping a lot. I think of stocks like Intel, right? All year it's up and down just a little, but every time they seem to announce earnings, the market forgets that they're a tech stock and they're down 10% or they're up 11%. So the third is that those individual stocks have a variance lower than the fully diversified stock portfolio. So low variance, leptokurtic, positive skew. What are those stocks? Well, Eli Lilly is one of them. WSO-P, DPZ, CWT. So you take a look at those, you take a look at the charts, and you see if those are the kinds of stocks that you'd like to look at. We produce this like we might produce natural gas if you've got an oil well. It's a byproduct. We're not going to throw it away. We're going to give it to you, right? And we've started to put this on Twitter. And in fact, at first I thought people didn't care. Our most popular tweet this month is where we talked about the stocks that popped out of our portfolio with these 3 attributes. So here we go. This was the chart that we produced earlier in the week when we published. And you see COS jumped out of the gate and then pretty flat. SMLP jumped a little, declined, came up a little. And then DIN dropped at the beginning of the week, climbed, and then flat. So the point is, they're different. They're acting differently. And so good stocks zig and zag, offset each other. That's how, for the first 3 trading days of the week, so let's say you gave us $1,000 and we ran this for you, your 3 stock portfolio would have been up almost 4% the first 3 trading days versus a 0.6 for the spider. So that's a pretty nice performance. $1 million invested, 4 points, 3 points of oversized return. That pays for the run pretty fast. I want to thank you very much for listening. If you made it this long, I'm going to ask you to buy an analysis. Let me tell you how to do it. You go to our website, chicagoquantum.com. You click Buy Analysis. Buy a common stock analysis using the Chicago Quantum Net Score to find efficient portfolios. That means you're not getting any extra risk. You're getting a minimum risk, the most efficient level of risk, and the highest expected returns that we can deliver to you. So it's efficient because for that same amount of volatility, you can't get higher expected returns. You just can't do it. So what are we charging? I Jeff, 10,000, 20,000? What are you charging? No, $100. $100 if you want us to run it without the quantum computer, because I got to pay for the quantum computer. $200 if you want me to also run it on the quantum computer and use the quantum portfolios to also augment and improve the classical run. It's like finding a needle in a haystack. It's finding birds that fly together. You're using a Sharpe ratio. It's nice. It's good. It's a good run, and it's going to give you stocks that I hope have the best chance of making you a profit. Now, some people, after the fact, they want to spend $100 and they want to talk about it. They want to go deep. They say, Jeff, I just had a Twitter message. Some guy wants to talk about the particle swarm solver that we're using and how we do it. If you're willing to pay $100, I'm glad to talk to you all day long about the particle swarm optimizer. In fact, I'll even tell you, if you buy the $100, which stocks that one chose, or which stocks the quantum computer chose, and were certain solvers better or worse? How did the energy landscape feel? The physics of the stock movements. That's when I get sounding a little crazy, so we're not going to go there. But we even have a simulated bifurcator that we use. And for those who maybe have a larger appetite, for $7,500 a week, we will work and we will produce code for you. We will code your algorithm idea for $7,500 a week onto our proprietary solvers. And so you can run all day. You can run every day. You can pick stocks every day. And I don't know that it only takes a week. Sometimes it might take longer, but it's a good way to get your best ideas into our portfolio optimization platform. And why is it only $7,500 a week? And then you get a platform? Because we're still losing money, and we want to bring in customers, and we're going to treat you right. So if you're an early customer, you're going to be treated with very special kid gloves, white glove treatment. So I'm Jeffrey Cohen. Thank you very much for listening. I hope you have a great next week in the markets. I hope this week was successful. And have a great weekend. Stay safe out there. Remember, Monday's a holiday. So see you back on Tuesday. Bye-bye now.